So Treasury, as I say, paying an interest rate of 7% on a 50 billion shilling loan. Are you happy with the rate Treasuries has settled at here?
Yes, I think they've done a good job of negotiating the loan. I think we must bear in mind that, first of all, there is an element of country risk, also an element of exchange risk, but also from what I understand, it's fixed rate. So I think looking at a rate of about 7%, although it's significantly above LIBOR, when you put those factors into consideration, I think it is a good deal for the Treasury.
I ask because, as I said at the top, it's been labelled a bargain compared to the cost of raising money from the domestic market. So international funding is something of a trend that seems to be picking up. Just to what extent, Paul?
Yes, I think when you look at interest rates in the domestic market, they are quite high. So by comparison, this is a welcome change in terms of the rate. And yeah, I think the need to source external funding, particularly because the current account deficit still remains quite sizable. So the gap probably would be filled by increased borrowing or increased capital flows of this kind from external sources. I think also the other advantage is that it takes out the effect of crowding out the private sector borrowing in terms of the domestic market, and hopefully bring interest rates down and bring stability to the upheavals that we have witnessed in the last, I say, 9 months or so in terms of the macroeconomic environment.
What kind of scenario does this place domestic markets in, though? I mean, in terms of domestic financiers that operate in this space?
Yes, I would expect that once the government gets this amount, it's going to be borrowing less and less in terms of treasury bills and treasury bonds in the coming weeks. It's still unclear in terms of the timing of these flows, but inevitably, as the flows come through, there will be less borrowing from the domestic market, which should force interest rates down. It'll mean that banks will then have surplus cash, which they then need to go out and lend to the private sector.
It's interesting because, I mean, you've had the central bank raising rates locally in order to stabilize the shilling on the one hand, decrease inflation. I mean, those are the priorities that the central bank has had front of mind. So do you think that there's a need for a rethink given this emerging trend right now, that we possibly need to see a change in tack?
I think in terms of the domestic borrowing, that's good news in terms of bringing down interest rates. But I think inflation still remains the one stumbling block to lower interest rates in Kenya. We are still looking at a very uncertain inflation environment. And therefore, the stance of central bank is likely to stay on maybe for the next 2 to 3 months. But inevitably, if you look at when you factor in the base effect on inflation, I think by the end of the year, we should be looking at single-digit inflation.
Yeah.
And central bank will have no reason not to bring down.
So the viability of lowering those rates are not yet apparent, Paul. What does this do in terms of exerting pressure on the banks themselves? We know that for the longest while, the trend has been for local banks over in Kenya, not to move in tandem with the kind of interest rates that the central bank has set. Does this put pressure on the banks themselves to start re-looking their strategy and their view on interest rates, bringing them lower, possibly faster than they had originally anticipated they would?
Yes, I think interest rates, again, like prices, tend to be sticky upwards. So I think banks might look to extend the lending rates to stay high for perhaps slightly longer, maybe the next 3 to 6 months before they begin to drop. But once the alternative of investing this money in lucrative treasury bills and treasury bonds, then the single option that's left for them is to lend. And if they need to lend more, then they need to adjust their rates. So inevitably that will come through. It might not come in as fast as we expect, but yes, I think it will come through.
Impact that you see this having on the shilling, because I mean the risk you're taking on going down this route, accessing international financing, is the exchange rate, as you alluded to, right at the top, and that has been stable lately. But that stability is as a result of the central bank effect, as a result of a high interest rate. So once you see interest rates coming down, and yes, you've projected that that's still a while coming, what impact do you see this having on exchange rate stability?
I think, first of all, the inflows of dollars should help stabilize the currency because, so effectively, although you wouldn't be getting the flows in terms of foreign investment in the treasury bills and treasury bond market, that will be substituted by the amount of loan. If you look at the level of import cover that central bank is sitting on, it's about 4 months. So in terms of the currency, there seems to be some level of stability in terms of the key fundamentals that drive the currency. So I don't expect that when interest rates begin to drop, that we are going to see a significant depreciation in the shilling.
Well, Paul, let's leave it there. Thanks so much for your time this afternoon. Paul Mwai is CEO of AIB Capital.